All right, how to build a portfolio. Building a portfolio, man, you have three different entities or three different areas. Yeah, that's right. Large cap, mid cap, and small cap. All right. So when you think about building a portfolio, you want to think about building a house, and you want your house to be laid on a firm foundation, right? So basically, what we're talking about is your large cap is your companies with strength, stability, deep pockets, large cash on reserve. They will ensure your nest egg against big losses in the market. Consider your large cap companies your safety net. Consider your large cap companies your safety net. And then you have mid cap. Mid cap investments will involve a little bit more risk, but they will also set you up for growth over time. Mid cap companies, a little bit more risk, not quite as established as your large cap companies. They have growth opportunities. They're more your growth companies. And there's your mid cap. And we're going to look at some differences in between these. And then you have your small cap companies. Now, your small cap companies, you'll notice they're at the very top. They represent the smallest amount of your capital. You can also throw in here options if you want to throw in here because we're talking about risk. Riskier the investment, the higher you want it up, which means you want the least amount of percentage of your capital going towards your riskiest things until you get more comfortable taking more risk. Your small cap companies are likely to be your startup companies that may be backed by some young management team. Potential for exponential growth may be there, but the track record hasn't been established. You see a lot of this with your IPOs. IPOs can be up here. You don't have really much of a track record for them other than what they have shown privately. But when they're a private company, they don't have to disclose all of their figures to the public. It's a private company. You don't want to put all of your dollars here, but you may like the risk reward chances that you get, and you're willing to take a chance. So let's take a look at some large cap companies. Did I? Okay, here we go. Large cap companies. You got Apple, Nike, Microsoft, Google, Disney, Home Depot. Basically, what we're saying is, man, if the market should crash, these companies ain't going out of business. Your large cap companies. You're gonna have your small mom and pop stores that might get sold or bought out. They might get acquired. But some of your big top dogs in the industry, if they go under, then the whole economy is going under. You know what I'm saying? Like if Home Depot go out of business, man, can you imagine what that'll do to the whole global economy? It's the same way that we bailed out all of the banks because the government said, hey, if the banks go out of business, how in the world will the whole world function? So we had to bail out the banks, which sucks. But we had to bail out the banks because the banks are huge companies that we can't afford to let them to go. They made the decision that we couldn't afford to let them go out of business. And if the government says that they can't go out of business, then that seems to be more of a safer investment, a safer foundation because they'll still be in business. Does that make sense? It still involves risk, but I'm talking about is a little bit more of a safer side to your risk tolerance than obviously some of your other companies. When you look at mid-cap companies, some of your mid-cap companies, Monster Energy, Chipotle, Ross, O'Reilly, EA Sports, these are some of your mid-cap companies. I know for some of you guys, like, man, I thought that would be a large-cap company, but no, they're really not. What it means is that they still have a market share. They still have a market that they can penetrate across the country or across the economy. They're not in every market. They haven't penetrated every market. They're in select regions of the United States or around the world. Whereas some of those large cap companies are everywhere or almost everywhere. So that's kind of the difference. Large cap are pretty much universal across the globe. Mid cap companies, they're more local. And when I say local, I'm saying, hey, they're more, okay, it's the United States versus United States, China, and Brazil. So when we say mid cap companies, we're talking more of the local economy market than we are talking about the global economy market. Still some room for growth. You take a little bit more risk because we don't know whether they might get bought out, whether they might have a bad quarter or a bad year, and they might tank. You just don't know. So it's a little bit more of a risk as it relates to comparing them to your large cap companies. And then you have your small cap companies. These are the companies that are really small. Some of them can grow and become mid-cap companies is very hard to determine. This is where a lot of the risk plays out. For example, Buffalo Wild Wings, they're really a small cap company, but they blew up. And for people that were in Buffalo Wild Wings at the time, they got rich. But now Buffalo Wild Wings are starting to regress. But they still have a market that they can penetrate, because again they have a smaller market share. They have a smaller market impact than the big dogs and some of the mid cap companies. So these are companies that could be considered growth companies. They have an opportunity to grow, but is management in place right? Will they do the right thing in order to grow and expand? Do they want to grow and expand? Are they cool with just being in the southern region of the United States? Do they want to grow to the western region and all that? Those are things that you find out as you follow the companies, as you listen to their CEOs, as they talk about what their future plans are, or what they consider guidance. It's basically their future plans. So just wanted to kind of show you some of the differences between the companies, and as it relates to looking at building your portfolio. Again, of course, I would say I recommend that you start with some large cap firm foundation companies so you don't lose. If you get into the game and you lose everything right off the bat, it's going to be harder for you to say, hey, I want to try again later. But if you get in the game, you build a firm foundation, and then you start taking little risk here and there after you built your foundation, then you're going to feel that much more comfortable in taking some of those risks when those opportunities present themselves to you. Does that make sense?
Well, here's how I look at building a portfolio. I look at it like a triangle. So you got your big wide base, and it goes up to your peak, the top tip of the triangle. The top tip of the triangle takes up the least amount of space, and the big base takes up the most amount of space. So the big base should be the most sound, sizable, solid companies, the most deep-pocketed companies out there that you can find. The hardest companies to take out in the world financially, because they're just a financial fortress. That should be your base. And then once you've got that covered, you can go up in the risk curve to something that's a little bit smaller and a little bit less, to some mid-cap stocks, that are just medium-sized companies, that they're not, your biggest. They've still got some more, a decent amount of growth still left in them, but they're not some little small fly-by-night mom-and-pop company. And, if you've got those tiers, I mean, honestly, I stop with pretty much those tiers. But if somebody wanted to, then if you wanted to put a smaller amount of money, because as the triangle goes up, you need to be putting smaller amount of money in, and you want your bigger amount of money in your big foundation at the bottom of the triangle. So if you want to, take a run at some young company that is newer that you think could fly and, be the next Apple or whatever, that's fine, but you want to make it a very small percentage of your portfolio. That way, if it totally goes under and it totally goes away, it doesn't deter you from being able to make a good return over time. So if that comprises 1% or 5% of your portfolio, that's probably fine. But you don't want a small company and you shoving 30 or 40% of your liquid net worth into that company because you're greedy and you think it's going to be the next Apple.